Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. Prices have sort of continued their move higher. Well, let's be honest. Last week the market did make a seeming aberrant move lower that was jump-started back up by hitting the slowly declining long-moving average below, currently at 1477. Anyway, the market moved up from the previously highlighted congestion zone made up of the lesser Fibonacci lines at 1400, 1389 and 1378. This overall move higher was also the result of the break up and out of the July to late October 2022 descending triangle, which I've highlighted in dark blue on my daily chart. The potentials on the upside from the descending triangle pattern, as I said 15 weeks ago, were, and I quote, "So taking all that into account, a primary target X would be in the 1545 area, and a secondary and much harder to reach target X1 would be in the 1605 area." End of quote. I also added something at the time which has turned out to be very prescient, and I quote, "So what have we topside that might get in the way?" Well, to be honest, not much, which is why I'm a little surprised and concerned that prices have not moved higher than they have. You see, we have highs in September at 1493 and 1508. The next clear resistance topside is in a band between 1521 to 1534, containing the flatlining long-moving average. Now, the long-moving average is obviously a lot lower and is currently at 1477, but going back to the quote, and the 50% Fibonacci line for 2022 at 1532, and that's the end of the quote. Well, since those words, prices eased higher, breaking over a number of capping factors. In the process, the action created and started utilizing a new pattern, a bull channel, from mid-November 2022, which is highlighted in purple on my daily chart. In this move higher, prices in February breached but did not break the next resistance. That's the 50% Fibonacci line of the February to July 2022 move at 1532. Prices did continue to edge higher 3 weeks and 2 weeks ago, and market reached up and reached target X at 1545. But they also headed lower 2 weeks ago. That extended into last week. 5 weeks ago, I gave two possible options for the way ahead, and I quote, "Firstly, we can go back to where we were within the purple bull channel again. This is possible, though the false breaks either side leave a lot of questions. Secondly, perhaps, just perhaps, the market is now moving into a shallower bull channel type action originating from late December, and the one I've highlighted in bright red. Currently that's 1499 to 1565. I suppose the third option would be a straight move lower, but I have a suspicion that may not be the way, at least right now." End of quote. Well, the market used the second option, and we have a shallower bull channel in bright red. I'm not totally comfortable with this new bull channel idea, not yet. Its testing and breaching of the lower bull channel line last week has placed a question mark over the recovery, as has the inability so far to reach up and test the 2022 high we saw 2 weeks ago. It may be that we have the beginnings of a sideways rectangle pattern between roughly 1480 to just over 1540. And that is something I'll be contemplating for the next few days. Chicago soybean meal. We have had here and have here still for months now different patterns, not so much melding in with each other, but rather crashing in and out of each other. The big pattern here is the May to date, seemingly broken, then repaired, ascending, expanding wedge pattern. A huge pattern that I had pointed out many months ago. This had developed for a while, but is now looking pretty ill. It was never a perfect pattern by any means, but it seemed to work until the end of last year. To assist in seeing this pattern, I have highlighted the pattern in dark blue. It's worth noting that the lower trend line is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. I was last time, and I also am this time, still thinking about downgrading it, as there's enough else going on nearby that deserves some closer and better attention. The next patterns to look at are the ones that caused the peak of the market in early and late December last year. It was a combination of the 2021 high at 471.40, inflamed, yes, I think that's a good way to describe it, inflamed by the neckline, which I've highlighted in bright red of the February to April 2022 head and shoulders top, currently at 480 even. I should perhaps clarify that the June 2014 high at 479.30 has also helped. Prices have since moved higher and away from the 2021 high and June 2014 high, and even this week up and away from the bright red neckline. However, the move higher brought these move higher brought with them conflict with fresh resistances, such as the 2022 high at 491.5 and a 2014 high at 494.40. The market has breached these, but has not as yet been able to break them. Now, looking below, we saw the market back in January drop down to just short of the April 2021 high at 439.30, where it basically gathered ammunition to turn back up in mid to late January. We also saw a smaller drop in recovery last week. These moves back up were due to one reason, and that's the rising short-medium moving average below, currently at 469.70, acting as a booster. It's worth remembering that for the future, just in case. This left us, as I have said over many of the last few weeks, with the question of what may be the likely patterns in the coming times ahead. Initially, I'd indicated there was a tendency to look at the late November 2022 to January this year action as a possible bullish halfway hesitation. That idea was for a while somewhat set aside, but it has resurfaced in recent days. It is far from ideal. In fact, there may be more than one such bullish halfway hesitation pattern operating at the same time. But that is all I'm comfortable with showing right now. So, with that in mind, the largest possible such pattern dates from November 2022 to date. This would give an initial potential topside target in the 484.40 area and a secondary harder to reach potential target X in the 512.5 area. Additionally, since the changeover in mid-January, we have a smaller potential bullish halfway hesitation with a separate initial target in the 494.5 area and a secondary harder to reach target X1 in the 513.5 area. Needless to say, both initial targets have already been reached, leaving us with the harder secondary targets. It all depends if the rally we've seen since the middle of last week is genuine or not. Chicago soybean oil. The key recent features here have been feature 1, the lower time, currently at 62.02 of the December 2021 to June 22 bullish shift pitchfork, which I've highlighted in dark blue on my daily chart. It's lower time along with feature 2, the April 2020 to date uptrend, currently at 62.89, which I've highlighted in bright red. Both halted the decline in mid-December last year, starting a small subsequent move higher. Or rather, they may have started it, but it was not accomplished just with those two. No. They had help from a whole series of other supportive features, including the 2011 high at 61 even, and supports at 59.44, 58.82 to 58.16, inside of which is the August 2011 high at 58.59, plus the September 2012 high at 57.64. This all caused the market to revert back up, and in the process form an interesting small ascending wedge pattern over December last year. I've highlighted this pattern in bright green on my daily chart. In late December, the market broke down through the base of the pattern, thus initiating a primary target in the 64.08 zone and a secondary much harder reach target X1 in the 58.82 zone. The primary target was easily reached, but it took until February to graze down to target X1 before being rejected back up again. It was only earlier this week that we saw a heavy move down through target X1 and the supports below from 58.82 to 58.16. So far, this congestion between 58.16 and 58.82 has held up the market, but we only need to look back to July last year to see that this support may be pierced down as far as the 56.30 area. The only counter to such a scenario is perhaps to look at the action this year as a possible sideways rectangle. However, I am not that confident as yet to be able to label the action as such, as I suspect we may see further attempts on the downside, especially as the neckline and lower time move higher and away over time.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.